Everyone wants passive income. Rental properties. Dividends. Online businesses. Royalties. But here's the problem. Most people try to build the top of the pyramid before they've built the base. And when the foundation is weak, everything collapses. Today, I'm going to show you the passive income pyramid, exactly what to build first, second, and third, so you're not just chasing income, you're building it in the right order. Let's break it down. Why order matters. Passive income isn't just about assets. It's about stability. If you try to buy rental properties with no emergency fund, if you try to invest heavily with high-interest debt, if you try to build complex businesses with unstable cash flow, you create stress, not freedom. The wealthy build income in layers. Each level supports the next. Think of this like constructing a building. Foundation first. Then structure. Then scaling. Level 1, the foundation. Active income stability. This isn't sexy, but it's critical. Before passive income, you need stable primary income, emergency fund, 3-6 months minimum, high-interest debt eliminated, basic budgeting control. Why? Because passive income requires capital. And capital comes from surplus. If you're living paycheck to paycheck, the first asset you build is your skill set. Increase your earning power. Negotiate salary. Switch industries. Start a side hustle. Your income is your engine. Rule of level 1. Your financial life should be stable enough that an unexpected bill doesn't destroy your plan. Once this layer is strong, you unlock the next one. Level 2, market-based passive income. Simple, scalable investments. Now we start building real passive income. This layer includes broad index funds, dividend-paying companies, retirement accounts, automated contributions. This is where consistency beats complexity. Why this comes second? Because it's liquid. It's diversified. It's relatively low effort. And it compounds. You don't need massive capital. You don't need special access. You don't need expertise in property management. You just need discipline. At this stage, your focus is automate, contribute regularly, reinvest dividends, increase contributions over time. This layer builds your financial base quietly in the background. It may not feel exciting, but it's powerful. Level 3, cash flowing assets. Now we step up. This is where income becomes more tangible. Examples: rental properties, real estate syndications, private lending, small business ownership, online businesses that generate recurring revenue. Why is this third? Because it requires more capital, more knowledge, more risk management. But it also provides stronger cash flow, tax advantages, greater control. At this level, you're not just investing in markets. You're investing in systems. And systems produce income even when you're not actively working, if structured properly. But here's the warning. If level 1 and 2 aren't solid, level 3 can create stress. Vacancies happen. Markets shift. Businesses fluctuate. This level works best when it's built on stability. Level 4, scalable and equity-based income. This is the top of the pyramid. This is where wealthy individuals spend most of their time. Examples: owning equity in multiple businesses, angel investing, private equity, building and exiting companies, intellectual property, large-scale real estate portfolios. This is not beginner territory. This is leverage territory. You're leveraging capital, people, system, brand, Distribution. Returns can be much higher here, but so is risk. The reason this level comes last is simple. You need experience. You need capital. You need risk tolerance. Most people fail because they try to start here. They see big returns. They skip the base. And they overextend. Wealthy investors climb the pyramid. They don't teleport to the top. The big mistake people make. They chase yield instead of structure. They see someone earning $20,000 a month in passive income and think, I need that now. But what they don't see is the 10 to 20 years of layers underneath it. Passive income isn't about speed. It's about durability. If your pyramid is solid, income becomes predictable. If it's rushed, income becomes fragile. Here's the summary. Level 1. Stabilize and increase active income. Level 2. Build automated market-based investments. Level 3. Add cash-flowing real assets. Level 4. Scale through equity and ownership. Build in order. Strengthen each layer. Reinvest upward. And remember, passive income isn't built in one big leap. It's built one level at a time. If you found this helpful, subscribe for more long-term wealth-building strategies.